So today I thought I'd just quickly share my UK value investing portfolio. One of the shares you'll see in a minute isn't actually in the UK, so I'm going to have to rename this pie. But this pie is a set and forget and sort of slowly contribute to regularly alongside my other kind of more growth focused companies. These are purely value plays. So the first one's actually Games Workshop. If you know Games Workshop, they make Warhammer. I'm just going to pull up a chart for you, one sec. So Games Workshop had quite a good year so far, but the dividend used to be very, very small relative to the share price. But actually they've stopped their share price has stopped going completely crazy because they did go absolutely nuts back in the day when they really started to make a huge amount of cash. But I think they're very stable. They've got a very loyal fan base, but then now the dividend's up to 4%, and that can easily continue to grow because they've got they're a very strong just a strong cash generative business. They also have lots of opportunity to dive into the lots of licensing agreements and things like that. It only takes, Amazon are looking for ways to make new content and they're happy to overspend. They spent $1 trillion on Lord of the Rings. There's all sorts of things they could do with Warhammer. There has been films recently as well, but I think that universe could easily be explored more and more, and they own a lot of the content, and content is king at the moment. So I think that's a big growth opportunity, but their underlying business is also really, really strong. So that's why Garmin. Or as I just said, Garmin, because that's the next share on my list. So if I pull up their chart as well. So I recently started running, which is what gave me the idea to even think about these guys. But Garmin been around for about, I think, 25, 30 years, a really well-established brand, and they make amazing products. They make the best products in the market, top of the range. The only other competition they have really is Apple, but Apple tend to be obviously for iPhones, and that's just something you're always going to have to deal with in the consumer electronics space. Um, they've tended to pop during the boom years. So pre-2008 crash, they went crazy, and same during their sort of running craze during COVID and things like that. But their underlying business is actually really good. I think last year they produced something like $3 billion in profit, and they're trading at a market cap of 20 billion. They have very low debt. This yield is 2.79%, but this could go up significantly. So I think they have grown this in the past as well. So I think there's a big chance they grow this in the future, because they've got a lot of cash. They're not growing very, very fast as a business, but they're ticking along, and they have lots of other different triggers that they can go into. So moving to aviation, they make a lot of money from boats, and boat people have tons of money. But there's all sorts. They also have a lot of the data and license a lot of the technology to other companies. So I think things like trucking, maybe there's lots of growth areas, but I think they'll also steadily continue. They won't decline, and they're hugely profitable. So I think they're a very safe bet at this price. They've come down a lot. I wish I'd bought here, but there's always that. And yeah, they seem like quite a healthy price to me. So adding them to the portfolio. The third company is GB Group. GB Group are a cybersecurity company, basically cybersecurity software as a service, but their executive team is made up of ex-Aviva folk who are very, very, very experienced. So the ex-CFO, and I think the CEO is chairman of the board as well of Aviva, who are one of the largest UK software companies there's ever been, actually. So they've kind of come in as a bit of a turnaround. I'll just show you their share price. They've been up in these echelons of £9.50 a share, and they've gone all the way back down, so down about 75%. So they've had to kind of clean up their shop and try and be a little bit better, quite frankly. But they're still paying out a dividend of they still increased their dividend this year, which is quite a bullish sign. I think it trades around 3-ish% if I remember correctly, but they increased it by 5% this year. But they've actually got a reasonable amount of cash and a lot of upside in a space that should do very, very well. They just had a bit of a messy M&A acquisition in the US, but it looks like the impairments of that have kind of been factored in. They're also just in a SaaS business where multiples have just been slashed, and like a lot of those businesses have just crashed through the floor in terms of share price. So They are probably they're definitely the riskiest of the two we've looked at so far, and the riskiest of all this portfolio. But I think the payoff on this for a small bet could be significant. And the last one is City Pub Group Limited, who I've known about for quite a long time. I'm just going to explain a bit about them here. So what I like about these guys is they are a pub company, but they actually acquire and own all of the land that they build on. So very similar to kind of semi-similar to the McDonald's model, and they buy only and they only set up shop in quite premium places. So London, the city, places like Cambridge, Oxford, Bristol, kind of those kind of really high-end market towns that tend to have a clientele that can afford to spend ridiculous amounts on beer and food. They charge a lot, but they seem to be mostly full. They do well. We have one. I used to live in Cambridge, and I know they do well there. And they've done, and I like the experience when I go to them. So I think they will do well in their niche. But what I like about them is their market cap is 89 million, but they're actually, sorry, their share price is 85, and if you look at the valuation of their underlying real estate, it's about £1.45, or it was the last valuation they did. That may have come down a little bit, but even if you knock off 10-20%, it's still vastly outweighs, and that's their kind of net assets far exceed their actual market cap. So they've got a lot of value there, and their revenue's actually not been too bad the last year or so. Ignore this PE, doesn't really, I don't think that's right. They fell off a cliff obviously during COVID, had a pretty bad time, and have slowly climbed up. And I think they'll return to sort of £1.50 eventually. And what they've actually been doing is doing a lot of buybacks. They got rid of their dividend and just started hoovering up. And they've been buying shares all this week, and all the last, I think it's like 6 months, maybe even 9 months. I held these guys for a long time. I held them in a run up from about not quite 58, but about in the sort of late 60s to about can't remember exactly, but around the kind of 90 or 85, 88, somewhere around that range. And they ran up all the way to £1, and then they've just started to tail back off again. So I think they're up 17% this year. So when you look at it that way, it looks much more healthy. And I think they're still deep in the value territory. If everything went to shit, they could just sell. So that's what I really like about them. They could just sell all their assets off, and you'd make money. So there's kind of no downside risk in that regard. I don't see those, and those markets tend to be much more recession proof as well. That's why I like them. And gas prices are coming down, etc. There's lots of kind of positives now, although the price of a pint is ridiculous. So they have been there's what make up my 4 companies in my value portfolio. Hope you enjoyed. I'm just rebalancing this now so that these other ones enter. I'm going to rename it, and I'll share the pie in the description.